focus on names like HDFC Bank, ICICI and Kotak. But Sonia's on the wall with more rates. Sonia.
Oh, thanks a lot for that. So it's a fresh record high for the index, right? Let's not lose sight of that. Given that this market has seen 6 consecutive days of gains, now this is the 7th. The Nifty is very, very flat, but yet it is a fresh record high at 22,200. Let's take it straight to individual stocks. Now, you have a lot of names that have been assuming leadership in the last couple of days. The one that we're looking at this morning is HDFC Bank. It's flat for now, but it saw large 2,700 crores of delivery-based buying yesterday. So it would be interesting to see how that one shapes up this morning. The other one is Hindalco, now up almost about 3% after Novelis has decided to file for an IPO in the US. So Hindalco picking up both in terms of volume as well as price action. Z, the clarification has come through that they are not involved in negotiations with Sony for a merger. And there you have it. You know, very bizarre moves on both sides for Z in the last couple of days. So better to be a bit cautious on this name, down almost about 10%. Let's look at some numbers. Of course, earnings season is over, but ABB India's numbers came through yesterday, 4% higher, as the earnings were better than what the street was estimating. And now volumes are also picking up on this one. Auto stocks were under pressure yesterday on the back of the Vahan data. This morning as well, there's some more follow-on selling. It's actually bucking the market trend. Hero Motors now down about 2%. It could also just be profit-taking because you had a big move in these stocks in the last fortnight or so. TVS Motor is the one that has been outperforming the market on the back of the success of the iQube, and it continues to be very strong. Couple of other names. Union Bank has been in focus. Sources say that the bank is looking at a 3,000 crore QIP. That stock is up almost 6% and big volumes there. JSPL, I would like to look at that one. There's an interesting brokerage report from Motilal Oswal this morning. They have a buy with a target price of 900 rupees on the stock, which is well above the current market price. And they say that capacity expansion in JSPL is something that will propel growth. I'm also looking at Grasim. Jefferies put out a report this morning where they have a buy with a target price of 2,300 on Grasim, but this one is just barely flat with a bit of a positive bias. Couple of more names. Devyani International, Yum Restaurants may look to sell 4.4% stake via the block deal. The floor price is 150 and that stock is well in the green right now. Overall for the market, it's not bad at all. If you look at it, 22,200 is holding after the big up move that we saw yesterday. And this is the focus area, the Nifty Bank, which is leading from the front this morning, up about 150 points. Back to you.
All right. Well, a couple of stocks are really moving big time in the broader markets. You have Campus Activewear. That stock is flying away. It's up 8.5%. Big move out there. Union Bank, Abhishek alerted us about their fundraising plan. So that stock as well is up close to 6%. Swan Energy, that's the other one that's already had a big run, but the prospects appear quite bright. The QIP, is what we were focusing on. Volumes are not yet picked up, I think so, but the stock is as flat as can be as we speak. Then Lakshmi Bank as well, up close to 3.5%, so that's the other big mover. And Devyani, it started off, I think, well in the red, and that one has done a U-turn, up close to around 4.5% as we speak. Other big movers include Zomato up 2.5%. You have Geo Financial as well, that's bucking the trend, up and about in today's trading session. And the Z stock, Z Enterprises, is down close to around 10%. Z Media is down close to around 5%. Massive volumes out there. Another big volume mover is Dish TV on the downside, down close to around 2.5%. So the market's well in the green. We have another fresh all-time highs, but stocks doing a thing of their own. Poly Medicare, you have a 1.5% equity that changed hands out there. So that explains why that stock is a little under the weather, down 1.5%.
Zomato is the top volume-led gainer today. This morning, its start. Zomato has got 4% in terms of gains, and it's large volumes, number one in terms of volume-led gains. Union Bank is coming up with a 5.5% pop. That's a number 2 position, 149 on Union Bank. I think ABB is at number 3 spot, 5% gain on ABB. Again, humongous volumes in it for this time of the day. There is, I think we mentioned, of course, Devyani. Devyani is up 4. Campus, we mentioned, I think Campus is up 8. 264, 265 on Campus footwear. Paytm is up another 5%. So 4 days on a trot now, 5%. So that's, come up to a respectable sort of 400 kind of levels. And we've been sort of pointing this out and discussing this. GIC RE is up another 5%. So 426 on GIC RE. GIC and New India Assurance both have had fantastic runs and both sold off yesterday. Stocks at about 428, as I said. New India sold off yesterday 10%. It's back up about 6%. So, these are just sort of pauses that that's at least what it's been like for most of these names in the PSU space. Just Dial is up about 3%. There is LG Equipment, which is up 4%. Tourism Finance Corporation, that block deal, It's up 5%, 231. I think the stock was up 5 yesterday as well. It was part of Nimesh's D Street chatter a few weeks ago as well. K Fintech is up 6%. Huge volumes. I mean, right out of the gates, this is a vibrant start. That's what I want to point out, because a lot of names with a lot of volumes. So this is not a tepid-looking screen any which way. Hero MotoCorp is down 2%, another down 2%. We were discussing this earlier, and Sonia pointed out that Vahan data as well. And with that 2% cut, Hero is the top volume-led loser coming up on the screen at this point in time. Sula sold off 8%, Sonia, yesterday. It's down another 3% as things stand right now.
Okay, I don't drink wine, so maybe.
You're a teetotaler.
Yeah.
But every time we have Rajiv Samant join us, I mean, you have the most questions. Yeah. So I thought, well.
About the wine tourism.
But you don't partake in the wine.
But I mean, jokes aside, you were talking about K Fintech, right?
Yeah.
Jefferies has put out a note. They've actually raised their target price on K Fintech to 760. And they look at a very high growth from international operations, from AIFs, from value-added analytics services. This space has been buzzing, right? A month ago, or rather a fortnight ago, when the market went to that 21,000, I think 100 mark, a lot of people were talking about how this rally has come to an end and we're dithering, etc. But just so quickly and swiftly, the market has sort of bought into the dip and got back to new highs. So it speaks a lot about the equity cult and how it's growing.
That's the key, Sonia, as you said. I think that's a factor which perhaps is a little underappreciated as well, because so much of domestic money is coming in, right? $2 billion of SIPs now, nearly $2 billion. I think 1.8 or so is the last month's number. Jonathan Garner is our guest on the show. He's a market master, Chief Asia and EM Equity Strategist at Morgan Stanley. Jonathan, it's a pleasure having you with us here on CNBC-TV18. Thank you very much for your time. Prashant this side. Jonathan, just on that point, I mean, unstoppable is the word which comes to one's mind. And you've been long-term bulls on India. I think you've been overweight for a while, one of the early ones. Just sort of capture for us how you're feeling about the market after the run that we've had. We're at new highs. So many sectors, like the entire government sector, is re-rated substantially. Your thoughts?
Yeah, so we're in what we call a new era for Asia and EM equities, led by India and Japan. So they are in strong secular bull markets. And what the two markets that we most favor in Asia have in common is strong nominal GDP growth and strong earnings growth. So if you look at the most recent quarter in India, for our stocks under coverage, earnings are growing around 23%. Year on year. For Japan, we actually just this morning published an earnings season update, and earnings are growing around 20% year on year. So there are very strong earnings fundamentals that are driving these bull markets. And that's in sharp contrast to China, which is not able to grow earnings in the current deflationary environment.
But it's interesting you talk about many of these economies, right? At a time when some of the world's largest economies are struggling, case in point, Japan that has entered into a recession, UK that is in a recession as well, and or in slower growth rather, and China where the property market is in a bubble. Do you think the case is now becoming stronger for money to come through into India despite the kind of rally we've already seen, Jonathan?
Well, what you just said, I just pick up on Japan in particular. Japan had very strong overall nominal GDP growth last year. In fact, around about 6%. In India, it's around about double that, 12 or 13%. And the Japanese corporate sector exports, and there are a lot of listed stocks in the export sector. And so what's crucial for that market is domestic growth, but also that the US keeps growing. And you didn't mention in your question, but the key surprise, I guess, last year is just how strong US domestic growth was and remains now in the face of these interest rate hikes. For China, it's not so much it's in a property bubble, it's actually for 3 years been in a deflating property kind of crash, really, one could call it. And that's permeating across the economy and producing this rather unfortunate downward spiral in property prices, wages, consumption activity, corporate profits, and ROE. And that's completely different in India. To circle back to India and why India is attracting so much interest, you're in a virtuous cycle in India of strong nominal GDP growth, strong capital inflows, corporate profits that I already mentioned, in the context of much more stable interest rates and exchange rates than we've really ever seen before in India. And all of this is a consequence of a persistent macro reform agenda that has really produced a much greater degree of macro balance in India, much more stable environment for investors of all forms than we've seen historically. So it is no surprise to us that India is in a persistent secular bull market.
My question was more about how much of it is priced in, you think? I mean, the case is very strong, right, for money to move out of China and into India because of the reasons that you mentioned. But how much of it is in the price?
Yeah, so that's a great question. So if you look at the two markets that we like, India is clearly the more expensive of the two. So if you look at profitability, which you always should do against price to book multiple, then essentially for Japan, return on equity is about 10% and price to book is 1.5. And that is actually very much in line with global average. Now for India, trailing a return on equity is around 16%, but price to book is 4 times. So it's got very high profitability, very high earnings growth, but also high valuations. In fact, valuations for India relative to profits are the second highest in the world after the US. So the debate for India is somewhat similar to the debate for the US, where of course the profitability is very concentrated at the top of the market cap spectrum. In India, it's probably a broader phenomenon actually than in the US. And so the question for India is how much room, how much compounding have we got to go? Because it is worth paying a growth multiple for a growth stock or a growth market if they're capable of sustaining earnings growth. And at the moment, we have confidence in that in relation to India. Ridham Desai and the team in India that obviously cover the market for us, we really do think that that 20% compound EPS growth is going to be sustainable for India on, let's say, a 3 to 5 year horizon. So this is it's a very interesting story.
All right. Hi, Jonathan. Good morning and good to see you in. Nigel on this side, talking about valuations. One part of the Indian markets which is not very expensive in comparison to its averages is the private sector banks. Quite a few of those large names in there, they haven't participated in this big run in the last 2 to 3 years. What's your view on private banks here in India and how do they stack up, private versus PSUs, which have done very, very well?
Well, I'm not going to comment on individual stocks, and I'm not even going to comment on the question you asked, except to say that the financial sector overall in India is performing. And that's the way that most of our clients look at it, particularly if you're an index player or, it's the key point is that the financial sector in India is going to benefit from rising economic activity, rising demand for financial products of all forms, and this growth in household and corporate leverage over time. If you look at leverage in India, for example, in non-financial corporates, it's around a third that of China, and household leverage to GDP, again, around a third of that of China or a quarter of that of Korea. So the road to run is very substantial for financial services intermediation in India. And again, it comes back to what I said earlier on. You have in sectors like that, or in, say, real estate or healthcare provision or broad consumer discretionary and industrials, you just have this growth opportunity and you're asked to pay a growth multiple for it. But that's something that investors, I think, are on the whole comfortable with, that we talk to for India. Japan is a different story. It's an ROE recovery story. And it's a market that hinges a lot more on global growth than the India story does for Japan.
Okay, now got that. Jonathan, I spoke with GQG Partners' Rajiv Jain last night, and he's one of the largest investors in India. And I asked him about, China plus one, not just in terms of FDI, but flows, portfolio flows. His point was that flows are yet to come. I mean, last 2-3 years, foreign flows in India cumulative have really not amounted to much. So it's a story yet to play out. His other point was that if you look at large global portfolios, exposure to India is not that large. So just wanted that sense from you because, you're on the other side, on the sell side with many of these firms around the world.
Yes, so obviously I didn't see the interview, but the comments do resonate. What you just quoted to me in the sense that what we are seeing is very large asset allocation inflows into Japan, multi-billion-dollar inflows. Remember that the Japanese market is, in index terms, roughly 3.5 to 4 times the size of India, in free float market cap. And it's a DM market, so it can attract a much broader range of interest. But for that specific point about China plus one or EMX China, Asia ex China, India's share in the EM index or the Asia ex Japan index is rising steadily. And what's happening is the outperformance is being matched by portfolio allocations. So it's this situation, again, another virtuous circle where the outperformance at new listings and the compounding of performance is driving a rising index weight, and investors are broadly keeping pace with that. But it's certainly true that you are not at this point yet seeing the very large inflows that you would get to Japan, where you get household name stocks that global investors have got to know and over the years and are now coming back to. That does lie ahead for India. That true global appeal I would agree, has not yet taken place. It's still an EM specialist or Asia ex Japan specialist market from a foreigner perspective.
Okay, got that. Coming back to India, let's spend a little more time to understand where are we in this upcycle, right, Jonathan? Because the last time we had a big upcycle like this, it was in that 2003 to 2008 period. If we relate to that time period, what stage of the upcycle are we in? Have we reached a mature stage yet?
Well, as I mentioned earlier, that the team in Mumbai is expecting at least 3 to 5 years of earnings growing as fast as they are growing currently. We've written a lot about India's decade, the decade we're in, as a decade-long thesis, and the thesis is broadly panning out as we had thought. In particular, around issues like inward foreign direct investment, private equity commitment, I guess the sort of some of these longer run growth and leveraging trends that we talked about. So again, it's really important to understand that this is happening at the same time as we've reached a structural break the other way in relation to China. And so we think it continues. There will certainly be twists and turns in the story along the way, but it's one it's right at the heart of our recommendations in Asia currently.
All right, Jonathan, let's wrap this down then with one comment on what you expect the Fed to do. As a house, what do you expect? At the start of the year, everyone was talking about multiple rate cuts and a larger quantum. Those expectations have been tempered down a little bit, which may be for good measure. What are you all factoring in?
Yeah, I'm glad you asked me that question last rather than first, because it's the right order to take it in. I think there's sometimes this assumption that somehow the Federal Reserve drives the system. And obviously, most of this interview, we've talked about the fact that it's Indian fundamentals and Japanese fundamentals and corporate performance and earnings that's driving stock markets. If the Fed was to engage in a significant surprise or shock in monetary policy, that would be of relevance to your audience. But if the Federal Reserve is just endogenous to an unfolding soft landing in the US with a disinflationary trend and interest rates gradually cool off, and that's our view, from June onwards, then it's not of any great relevance, which is why it was right to ask me at the end rather than at the beginning.
All right. No, absolutely. Jonathan, it's a pleasure having you with us here. Thank you very much for joining us, and I hope we can speak more often. Thank you.
Thank you. Thanks a lot. Bye.
Being here. Goodbye. All right. Well, let's move on now, and let's get you, a snippet of that sort of exclusive conversation we had. This is a CNBC-TV18 exclusive. Rajiv Jain of GQG Partners is one of the largest foreign investors in India currently, with India investments of some $22 billion, global investments of almost $130 billion. I spoke with him, and he explained his thought process on investing in the infrastructure space. I mean, his big bet is on the big infra build-out. Airports, for example, is a big area. But I began by asking him how India, because they invest in markets around the world as well, how India compares with other large developing markets, especially those which are similar to India, a good mix of public and private companies. Listen in. Hello and welcome to this special edition of Market Masters. I have with me today Rajiv Jain, Chairman and Chief Investment Officer of the asset management firm GQG Partners. Although Rajiv has enjoyed a storied career with market-beating returns for a long period of time, he really attained celebrity status here in India when he boldly bought into the Adani Group companies last year. This was at a time when the group was going through tough times. That bet, by the way, has already paid off spectacularly well. With assets under management of nearly $130 billion globally, 22 of which are in India, GQG is a force to reckon with and is also one of the largest investors here in the country. Welcome to the show, Rajiv. It's a pleasure having you with us here.
Thanks for having me, Prashant.
Rajiv is an investor who sort of, looks at markets across the globe and invests across the globe. How does India compare to other large developing markets, especially those where there is a good mix of public companies and private companies represented in the stock markets?
Yeah, Prashant, as you know, there are a few very large emerging markets, and India is one of them. There has been too much focus on China, in our opinion, over the last 7-8 years, and that's beginning to diminish. So I think if you look at the larger markets, Indonesia, India, Brazil, Mexico, and so on and so forth, India, I feel, is one of the best earnings growth stories. So if you leave aside everything, simply look at corporate earnings growth over the last 5 years, which is basically pre-COVID till today, India has seen one of the best earnings growth amongst all emerging markets as such, right? So far better than Chinese corporate earnings have actually declined, which I feel this doesn't get enough airtime, that at the end of the day, earnings drive markets, and when corporate earnings are as strong as it has been, generally the market will follow. And India, Brazil, Indonesia have been some of the best, but India has actually been remarkably strong corporate earnings growth.
Do you think we are pricing a lot of that good earnings growth, Rajiv?
Well, that's a $1 million question, as they say. I'm not so sure. I think I feel that markets typically climb the wall of worry, and there's always angst about having run up so fast, that there could always be a pause. But if you take a slightly longer term view, I feel that India still has quite a runway. I'm talking about sort of 3-year horizon. So the valuations are maybe a bit extended, but not crazy. So because you always have to look at the runway in front, and the runway is fantastic. So if I look globally, actually, the two markets that I feel have the right dynamics for very strong returns, one would be, after US, I would say, would be India and Indonesia.
Mm. And even in terms of returns over the last couple of years, I think India and US are right up there, right, in terms of
Yes.
returns that they've given. And just to sort of press on that point, 1 minute longer, one refrain, one hears quite a bit nowadays is that there are no worry on the horizon. I mean, things are looking absolutely clear. In fact, I've even heard someone say the only thing to worry about, that there is nothing to worry about. Now, that sort of thinking is basically inviting trouble. I just wanted your perspective.
Well, things always come from unexpected areas. For example, if something goes, Middle East could flare up a little bit. Oil prices could be higher for longer, and there could be a spike. I mean, those are the classic India worries people have. Oil prices, although I think there's less impactful than used to be for various reasons. I think the biggest worry should be that a lot of mid caps have run up quite a bit. So could there be a pause? Entirely possible. And then markets, have these 10-15% sort of shakeouts, or some people call it the pause that refreshes. There's nothing wrong with those pauses, but I think fundamentals are reasonably robust. So we're actually kind of in a glass half full, not glass half empty mindset. We do feel that it is not a bad time to be kind of a risk on, despite the run up. I'm talking about globally, what we've seen. You also have to remember that this is an election year in US. Election years typically means that there's more stimulation, whether fiscal policy or monetary policy. Inflation is reasonably well behaved. So from a global cross currents, I think the whole inflation spike that we saw 2 years ago is kind of behind us. Some of the forward leading indicators of inflation are actually pretty benign globally. And that has implication of monetary policy. And the elections generally means that politicians typically in US also, you would see more stimulus. And that tends to bode well it's more this kind of more short-term view, not sort of 2-3 year view.
Okay, let's get specific now. Your big bets in India seem to be the fact that there'll be a big build out of infrastructure, right? A lot of your Adani Group investments speak to that belief. these investments have done extremely well for you. Do you think that concerns regarding financing access for the group, for the Adani Group, for global banks, bond markets, etc., that is largely behind us now?
I think there seems to be a common misperception about this group. So if you look at closely, based on our numbers, between 5 to 7% of EBITDA is all that is needed for maintenance capex. The rest of the capex is growth capex, right? Which is much more easier to tone up or tone down based on the opportunity set. And if you look at in India today, the opportunity set is very, very wide. And if you look at, for example, the renewable platform, now Adani Green has become the largest renewable green platform in the world already. Ørsted, which was the big Danish company, is struggling. So capital is not a problem in vast majority of these. I mean, some obviously would be more attracted to outside investors because of the mining exposure, etc. But as the markets have shown, there's more than enough appetite. So that was not a concern, even by the way, in March, April, when we first initiated, as we did the math, that capital is not a problem. When you're generating these kind of basically high teen underlying IRRs, capital is always around.
Got that. You know, your last big investment was GMR Airports, at least the one which was sort of publicly disclosed. Could you share with us what has been the driving logic there?
As you know, we quite like the airports globally, as long as the regulatory environment is sort of understandable and stable. In fact, one of the big underlying bets for Adani Enterprises was that. And so GMR, after the cleanup of the structure, it's now basically one of the largest airport operators in the world. As the regulatory reset comes through, which will happen over in terms of what they get paid, there's a meaningful upside to EBITDA as they go forward. And I think this was because of the history of the group with the other infra assets, which now have been cleaned out. I think this was a little bit less recognized, we thought. And I think that also puts some sort of value on enterprises because Delhi Airport, if that is worth 10 billion plus, by the way, we feel that could be worth a multiple of that because you still have passenger growth running at mid-teens. We have talked about airports of Thailand. We talked about some of the other airports, Sydney Airport, large sort of comparable airports. We feel there's not only the passenger growth, but also the ability to develop real estate, et cetera, around that, which historically was not as fully monetized as they're planning to do now. So we feel that there's meaningful upside in these assets. And as you know, these are very long tail assets. Airlines come and go. Indigo is a fantastic airline, but airports, if they're reasonably well run, have a very, very long tail. So we feel that they should not only have a very stable growth, but also will trade at probably higher multiples on a long-term basis.
Sorry, you mentioned enterprises. You were talking about the Mumbai airport, the Adani airport,
yes.
Housed within it. So just, could you just run us through that once again? What's the valuation argument there, and how does it connect with your investment logic in GMR?
So as you know, they own 6 airports, and Navi Mumbai would probably be done end of this year. It may end of this year or maybe early next year, but it'll become the largest airport as such in the world with passenger volume growth running at mid-teens. And there are other sort of abilities to monetize around that, because I think if you look at Zurich Airport has monetized a lot of different things around Zurich. Same thing for Paris. Same thing, less for Frankfurt. So there's a lot of ability to monetize not only the passenger, but also the revenue which can be generated in the ecosystem as such. If you put reasonable valuations that at that point last year, as you know, when we bought the first tranche of Adani Enterprises, we thought the airport itself was worth more than the company. And the copper business is coming online maybe in a few months, probably 6 months. That could be $1 billion plus EBITDA alone. So I think when you add these up, we thought we were getting basically everything else for free. Not to mention, the management. If you look at Gautam Adani's track record, his track record is phenomenal in terms of creating value. So just the airport itself was worth more than enterprise, we thought. And now, if you look at the other things that have come up. So the funny thing about some of these names is that the earnings growth in last 12 months, basically 12 months or so since our first investment, has been quite fantastic. Versus what we were expecting March, April. So the delivery has been quite remarkable. So I think that's an important part, because the whole infrastructure space in general has delivered very strong returns.
Okay, all right. That is GQG Partners. Remember, you can catch snippets of this conversation all through the day and the full show at 5:30 p.m. this evening only on CNBC TV18. Let's slip into a quick break. On the other side of the break, Parminder Chopra, the Chairman and Managing Director and Director of Finance of PFC, will be decoding their Q3 numbers. Do stay tuned in.
Welcome back. Well, as promised, let's get straight to the management of PFC. Remember, the stock has been a big outperformer in the last 15 months or so. To understand what's going on at the company, we have Parminder Chopra, the CMD and Director of Finance of PFC, who joins us on the show. Good morning, Ms. Chopra, and thanks so much for joining in. Well, give us a few basic details, ma'am. For AUM growth for the current fiscal, what do you end up with? And for the next fiscal, how is it shaping up? And if you could also throw some color on how much your par and your non-par mix is likely to move in the time to come.
Yeah, good morning. On the growth front, I would like to say that we have been maintaining that we are going to have a sustainable growth levels from 10 to 15% this financial year, as well as going forward for the next financial year also. On the disbursement front, I would like to share that this year on 9 months to 9 months basis, we have already grown more than around 70%. But the speciality or the pattern for the disbursement for the current year has been that it is being even out throughout the financial year, and consistently we have been performing in all the 3 quarters on the growth front. So last year, the pattern was 55% has been done in the first 9 months, whereas 45% was done in the last quarter. So this year also we are expecting that we will be growing in the range of somewhere between 12-13% to 15% on the incremental base.
All right, Ms. Chopra, just a couple of points here. You're guiding for 10 to 15% growth. That's quite a wide range. Will it be closer to around 15% or will it be closer to around 10%? If you could just narrow down on that range. And also if you could tell us about this mix, this par and non-par, because you're looking at non-par, the par sector has a lot of tailwinds and you have good competency out there. But in the non-par, it'll be interesting to see how you cope up. Give us your comment on that.
See, what we are expecting somewhere 12-13% to 15% for the current financial year. And going forward also. So you can very well say it will be somewhere, it's a very narrow range, what I believe. On the mix between the par and non-par, we have been allowed, even though we have been allowed for the infra space funding since October 2022, and we have sanctioned number of projects. But since infra projects generally take time to convert it into the disbursement. So we are expecting that next year, whatever sanctions we have done on the infra space, be it the metro, be it airports, we have funded refineries, we have sanctioned ports and other infra also. So we are expecting that all these are going to materialize in the next financial year. But we are going slow and consistent in the funding of the infra sector, because you know that there is a cap of on overall basis 30% of the disbursements.
Okay, so just to clarify, earlier you had guided for a 15% AUM growth in your conference call, but now you're saying that it could be 13 to 15%. So you've lowered it a tad bit, right? Is that fair? Is that fair to assume?
You can, I think that it is going to remain in that range only. We may
Okay,
touch
okay.
50%, but
Okay, just trying to understand how. But the reason I'm asking you is because, there is some segments which are seeing very slow growth, right? Whether it's generation, transmission, the distribution business growth has been quite slow. Are you facing any pain over there?
I don't think that there is any slow pace of capex in either generation or transmission. And on the distribution front, that two of the government schemes are running. One is the LPS, under which we are funding LPS and RBPF. And the other one is the RDSS scheme, on which, even though there has not been any disbursements during the current financial year on the counterpart funding which is being provided by the nodal agencies, we are expecting that next year it is going to be there. And it is going to pick up the pace, because lot of process about the sanction, award of contracts, etc. has now been completed. So next year we are going to see the work on the ground, and accordingly the disbursement on the distribution schemes is going to happen.
All right. Ms. Chopra, hi, good morning. Prashant here. I just want to press on the infra point. Actually, the bigger story really, which many investors talk about, is that who's funding infra in the country now, large infra projects. If you look at it, most private banks are out of it. Everybody wants to do retail. I mean, at least that's what's happened over the last 10 years or so, right? So actually large infra funders are, I mean, you guys are there, and maybe, on the PSU banks are there, right? So it's kind of diminished. And infra capex is now picking up, unlike the last 10 years. So, you did briefly mention on infra, there is a big gap between, you said, sanctions and disbursements. So, could you just explain that?
See, like I can give you an example that when we sanction the project, the contracts are yet to be awarded, and in times certain approvals are yet to be obtained from the relevant authorities. So these are put as either pre-commitment condition or pre-disbursement conditions. And these, once the complied, only then the actual disbursement starts. Based on that, whatever advances are required to be given to the contractor, and the work at the ground level is started. So conceiving an infra project and actually disbursements taking off generally takes, as per our experience, between 1.5 to 2 years minimum. So that is the time lag is always happening. So that is what we were referring to.
That you're going slow, and that's a great thing in that space. The demand is there, but you're being prudent in that sense. Could you just talk to us about the cost of money for you, cost of capital? What is it in the fourth quarter? What's your expectation, and what's the what margins should we expect? Net interest margins for F525 as you see it now.
On the cost front, yes, everybody knows that the costs are, interest rates are on a higher. Last time also, if you see, we have said that it is expected by the market that higher for the longer. So we are, this is what is we are experiencing. So this quarter, if I say, our cost of borrowing has been around 7.25 to 35. So there we are on the cost front, but we actually pass on at these costs in our lending interest rates also. And this is how you may have seen that there has been a 10 bips increase in our yields also. So as per our earlier guidance, we are expecting that our spreads and margins are going to be in the range of 2.5 for the spreads and around 3 to 3.5 for the margins.
Okay, all right. Ms. Chopra, final question before we let you go. Could you let us know what the status of the stage 3 assets, and when do you see meaningful resolution?
See, stage 3 assets, you know that we have reduced drastically the stage 3 asset if I talk about 4 years back. So now our stage 3 assets is around 3.5%, and net stage 3 asset is less than 1%. We are at 0.9%. And I think this is one of the healthiest NPAs, net NPA levels in the industry. Going forward, also, we are expecting in the Q3, we have resolved one of our asset that was the dance energy. It was PFC's exposure was around 400 crores, and we have recovered around restructured with a sustainable debt of around 85%. This quarter also, we are expecting two more assets to be resolved. One is the Lanco Amarkantak, and the other one is the Shiga Energy, where we are expecting good recovery to happen.
All right. Okay. All the best. The stock has given great returns to shareholders. In the last 12 months, the stock is up about 260%. So congratulations on that. And all the best with the business as well going forward. That's Power Finance Corporation.
Yeah. Sonia, in terms of the stock returns, we run the show inside out. And in December 2022, give and take everything, there was no buzz about the company at all. And it's online if you want to check it out. We had covered the stock, explained it at around 135 odd, and we had said that there's an alternate way to play the power sector. And we had put out valuations out there. It was trading at rock bottom valuations from there. And from there, it's done quite well because we covered it at around 130, 140 rupees. And the stock ran up quite a bit from there.
Oh, absolutely. And the management sounding very confident as well. Let's move on. JB Pharma is on an acquisition spree. It acquired 15 ophthalmology drugs from Novartis Innovative Therapies. It reported muted revenue growth in Q3, while the CDMO business has declined. Nikhil Chopra, who's the CEO and whole-time director of the company, joins us now to talk about that. Nikhil, thanks a lot for joining. And I think ever since you've done those acquisitions, we haven't had a chance to chat. So tell us a little bit about them. What do the acquisitions bring on the table for you? And, this is the 5th acquisition in the past 2 years to expand the Indian markets for JB Chemicals. Do you have any plans for further M&A?
So thank you, Sonia, Niger, to be back on CNBC-TV18. And on the world of ophthalmology, it's a growing market. We're talking of 4,000 crore market as reported in Indian IPM. And this market is growing at a pace of around 14%, better than the Indian pharma market. So what we have acquired is not 15 brands only, we have acquired 10 brands, and this is more in the area of glaucoma, NSAIDs, that is pain, anti-allergics. That is where we are, and this business is close to around 175 crores. Right now, the agreement is in licensing, distribution and marketing of these 10 brands. That is how it will continue for 3 years with thin margins. And in January 27, when we pay them $115 million, this entire perpetual license comes to JB. That is where we are excited about this opportunity. Meanwhile, we are looking at how do we get into more therapeutic areas within ophthalmology, launching our own products and expand the field force.
Okay, I want to understand that a little more. How are you planning to get into ophthalmology in a bigger way? And also, would you be interested in an asset such as Novartis India?
I would like to reserve my comments on the second question, but let me talk about more ophthalmology, what we have done. Expanding ophthalmology is looking at how do you get into more therapeutic segments within ophthalmology. The 10 brands that we have acquired, 5 brands out of those 10 brands are #1 in their category. It's a combination of products in glaucoma, antibiotics, pain. The therapeutic areas which we are not into, at some given time, we will try to get into understanding better the ophthalmology market, dry eyes, biologicals. All those should come over a period of time. Yeah.
Okay. The second part which you reserved your comments for, so I have to press you a little bit. So are you, is that something you would looking at, is it under active consideration?
No.
So it's not, it's a no to, so nothing happening and nothing will happen?
No, nothing. No. We are, Prashant, if you look at the way we are positioned today at JB, we are present into now half a dozen therapeutic segments. We are a big dominant player in the world of cardiology with our organic brand Silacar, Nicardia. We are now into probiotic market. We are into heart failure. We are into pediatrics. We are into respiratory. Now we are into ophthalmology, GI brands, Metrogyl, Rentec. So we have many things in terms of how we can explore the opportunity and grow better than the market. Our guidance has been Indian pharma market should grow at around 8 to 10%, and we should grow around 12 to 14% in Indian pharma market. So enough is there on the plate in terms of what we can harness.
Hi, Nikhil. Morning. Good to see you. When the stock price has done very well in the last few years once the PE took over, KKR. Now they're making good money. And as is the case with the line of business, at some point of time, they'll want out. Have you heard from them, or do they intend on holding on for longer?
Very difficult for me to comment because I am on the management side and I continue to do my work as responsible for running the business. With what we have, what we acquired in 2020 and where we stand today, I think it's a good asset that we could run. And I see a lot of opportunity within India business, within CDMO. I think what Sonia was talking about, CDMO, sluggish growth for the quarter. But if you look at what we have done with our CDMO business outside India, almost double the business. And from here also, the aspiration for next 3 to 5 years is how do you double the business with some of the big multinational partners, with some of the big branded products that we have got in the world of CDMO. Within India also, we have 5-6 brands in top 300. So a lot of opportunity in terms of where we see company running from here next 3 to 5 years. That is what I can say at this moment of time.
So for CDMO particularly, you have around 100 crore run rate on an average, right, in terms of revenues. But this quarter, I think you've slipped a little bit. Going forward, what could the average look like? I mean, do you think you can do better than 100 crores?
So, Sonia, if you look at going in the history of CDMO, when we acquired this company, JB, KKR, the CDMO contribution was 5% of the revenue. It was close to $20 million. Last year, we could achieve $50 million. All is organic build-up in terms of how we have doubled the business in last now 3 years. And the business has been 100 crores every quarter. Last quarter, we could touch 89 crores as what you have been flashing. But this is what happens in this entire part of the business. The first half of the year is on the order book that we get from our partners. Quarter 3 is a little bit sluggish. Quarter 4 onwards, we start getting orders for next 6 months of the year, where we see healthy trend in terms of where we stand today. And I think the way we have been running the company and a lot of developmental new projects are there in terms of getting into new therapeutic areas like sleep disorders, immunity, wellness, oral thrust, adding new partners, new geographies in Brazil, Mexico, Europe. I think the aspiration is to be close to $100 million in next 3 to 5 years. That is what we have kept as a aspiration goal for ourselves.
All right, we'll leave it there. I was looking at the price performance for the stock. It's incredible. I mean, it closed 2019 at $200. It's at 1620. So one of the better stories in the entire pharma space. Actually, one of the best, just in terms of sheer outperformance. Thank you very much for joining us. Great speaking with you here on CNBC-TV18. Good luck. All right, well, let's JB Chemicals. Well, 22,240 is where we are at. The market's also perked up a little bit. We'll just take a quick look at what's happening in the broader market. 2:1 is the advanced decline ratio, and it's all good. No complaints at all. ABB, by the way, is now up 8% while we were speaking with management, etc. It's come up to the day's highs, and it's got tremendous volumes. ABB. There is Union Bank, I mentioned, GIC and New India are top of the leaders board. New India's got 12 and GIC has got 10%. Campus has got 10%. A new addition to this list is Piramal Enterprises. Piramal Enterprises is up 6%, was nowhere in the mix early on. There is Shilpa Medicare, which is also up. Shilpa Medicare has been having a good week. I think it's up 20% this week so far. Another 6.5% right now, and huge volumes in it right now. Raymond is up about 4%. These are some of the newer sort of additions to what's happening in what is a very vibrant morning as far as individual names go. But we'll take a quick commercial sort of a break here. We'll come back. Manisha will put the focus back on some commodities which are moving. Stay tuned, that's coming up.
All right, well, this market is looking good. There's no two ways about that. The Nifty is holding on to 22,200. The Sensex is well above 73,000. Let's get a quick handle on what's happening in the technical space. Mitesh Thakkar joins in now. Mitesh, hi. This market is building onto its gains day after day. At this point, is the risk reward still favorable for traders on the long side? And what are the stocks to look at?
Good morning, Sonia. I think on the index, getting into new highs always means that the historical supply pivots are not there. So I think, yes, in that sense, I would maintain a long bias, suggest buying Nifty with a stop below 22,100 or levels, which is roughly about 150 point kind of a risk. But I do expect 300-400 point kind of a rally and a continuation of markets from here. And on the stock side, Nifty Realty is also making a new high. So I've picked up DLF as one of the stock recommendations. That's a buy with a stop at 868. Look for targets of 925. And the other one which I like is ICICI Bank. Disclaimer, we have recommended this stock to our clients. Open with a gap up to make a fresh swing high. That's a buy with a stop at 1,045 for targets of 1,095.
Okay, well, Mitesh, thanks very much for that. Let's move across and talk about commodities. Manisha is standing by with what's top of mind. Manisha.
Thank you for that. I'm looking at the sugar prices because we've seen some support continue into this one in the international markets as well, for that matter, and there is support for the sector as the street believes that there could be an ethanol review meeting that could take place this week itself. Well, when in the month of December, when the government had curbed use of cane juice and B-heavy for ethanol, they had also said that there would be a monthly review meeting for this. Well, January came and went and we did not see that meeting happen. So before the month of Feb ends, there is a strong expectation that you will see that meeting happen here. Also, when you look at the diversion numbers for this year, they are much lower, curbed at around 1.7 million tons. Last year, the diversion from sugar to ethanol was a big 3.8 million tons. So while we are less than half of it at this point in time, the street does believe that you could see some addition in these numbers there. Well, when you look at the market reports in sense of response to the second tender for ethanol of around 2.76 billion litres, it only has been to the tune of 1 billion litres. So this is something that has been weighing on. Also, apart from that, the sugar sector has been pushing for a formula-based ethanol policy. Whether we hear about that in this meeting or not is something that is still out in the open there. If you look at the Indian report card, then for the year 2023-24, we're looking at a production number higher now, lower as compared to the previous year, but higher than what the initial estimates were at around 32.5 million tons. Consumption is estimated at 28.5 million tons. Now, this is an important number, the carryover stock. The Indian norm is 6 million tons. We're looking at an 8 million ton of a carry forward stock. So what the street believes is that this extra 2 million ton that you could be looking at is what could come in sense of divergence towards ethanol. Whether that happens or not is something that we will have to wait for the meeting to happen to understand. This is the ethanol blending targets. 12% is what India achieved last year. Now, for this year, the targets are 15%. But with the way the tenders have come in and have been tendered at, the markets believe that 15% is a very far-fetched number on the street right now. Even if we achieve 12% is going to be quite high. Many of the industry participants also feel that it could be below 12% as well. So this meeting, as the timing comes in, is going to be very important in that sense as well. Now, to achieve what a government has put out for 2025 in sense of 20% blending, almost 1,016 crore litres is required. While we have seen investments go in for this one, but as I said, this meeting is going to be quite important in sense of divergence, what kind of targets is government putting out, whether they review it or not, and of course, whether there is going to be extra expenditure to ensure that we meet those targets. So this meeting is something we'll watch out for.
All right, Manisha, thanks very much for that. We'll take a quick commercial break here. Markets up 40 points, so good going. On the other side, my colleague Lata will chat with Saurabh Mukherjee of Marcellus Investment Managers and Digant Haria of Green Edge Wealth Services for a deep dive into HDFC Bank. Stay with us.
Welcome back. The HDFC Bank stock saw decent institutional buying, probably to the tune of about 2,600 crores yesterday after the management spoke at an investor call organized by Goldman Sachs. Now, what were the key takeaways for investors in terms of EPS growth from this call? And are these takeaways enough to end the underperformance of this stock over the past 2 years? For these and more questions, I have with me Saurabh Mukherjee of Marcellus and Digant Haria of Green Edge Wealth. Gentlemen, thank you very much for your time. Saurabh, to you in particular, you've, I think, got up early for my sake. Well, for starters, what did you take away from Shashi Jagdishan's Q&A?
Look, I watched Sashi's interview with the Goldman Sachs analyst yesterday, and I met Sashi last week. And our reading is that these guys are confident about the fact that the merger will proceed reasonably smoothly. Yes, there is a liquidity crunch in the system as a whole. It's not specific to HDFC Bank. In fact, in the quarter gone by, HDFC Bank and Kotak Bank were one of the few banks whose NIM held up. The other banks have seen a crunch in their NIMs. There is a liquidity crunch. And I don't think Sashi can be blamed for that. It's a system-wide issue. But Sashi and the HDFC Bank team seem relatively confident of dealing with the consequences of the crunch. The consequence of the crunch is raising deposits has become very hard for all banks, including HDFC, which is why the whole sort of hoo-ha in the market about HDFC's EPS growth basically coming to a standstill as they struggle to raise liabilities. What is a very, very tough market for raising liabilities. I haven't seen RBI liquidity at this sort of deficit levels in my 15 years in India. And Sashi and the team, given the circumstances, are pretty sanguine that they can deal with it. My reckoning is we're looking at NIMs bottoming out for HDFC Bank. We're probably looking at a couple of quarters of single-digit EPS growth for HDFC Bank. And then as they pay off the HDFC liability, as they pay off the more expensive HDFC liabilities which they've inherited, I think we'll once again see NIMs moving forward and EPS growth kick in perhaps 2 to 3 quarters out.
Okay, so you think, therefore, the stock price is condemned to be at current levels at underperformance till they jump to double-digit EPS growth?
I'm not so sure the stock price will stay where it is. These are incredibly inexpensive levels given HDFC Bank's history. You're looking at, I think, 12, 13 times earnings, 2 times book value for a bank which has grown at 20%, grown both sides of the balance sheet at 20% consistently for long periods of time, to trade at system levels of PE, to trade at overall market levels of PE doesn't make sense. India's historical market PE was around 13, 14. HDFC Bank is trading at that when the Indian market itself is trading at 20, 21. That doesn't make any sense to me. My reckoning is we will see institutional buying at a pretty healthy level, even as EPS growth stays reasonably weak over the next couple of quarters. I don't think investors are going to wait for earnings to pick up before they load up on the stock, because the story is really reasonably clear. It's a believable story. It's a clear story that EPS growth will pick up as the liquidity situation improves, and EPS growth will pick up as the high-cost HDFC liabilities, the inherited liabilities, are paid off. So I think the market will in effect buy ahead. The market will buy ahead of the EPS growth picking up for HDFC Bank.
Yep. No, Jagdishan's point that as the old liabilities of HDFC come down or are redeemed, there will be an automatic improvement in the margins is well taken. But Digant, one of the points he very clearly made is that they are going to prefer margins over growth, that they will give up on high-cost deposits. And if you give up on high-cost deposits, you have to give up on loan growth as well. So it clearly is going to be margins more important than growth, loan growth. How would you comment on this statement? How would you receive this as an investor?
So, Lata, thanks for having me. See, I think it's not a surprise that he made that statement that, we have to sacrifice growth in order to maintain margins. Because, see, after the merger, the CASA ratio fell from 38% to 28%. And if you look at last 1 year, HDFC's deposit rates, which it is offering to all kinds of investor, retail, senior citizen, is at least 25 to 40 bips higher than SBI. I have never seen this in my 16 years of tracking the banking sector, that HDFC is so desperate, and they need those deposits because they have to digest a very large merger which was pushed upon them. So I think there is no easy way out of the current situation, Lata, that they will have to fix the deposit side for the next 1 or 2 years. Right now the macro is also very bad. I think after elections macro can become favorable for deposits, but it still takes a few more quarters. I don't see any magic pill for HDFC Bank where it resumes the growth and the margin leadership both. So I think re-rating, if any, will be very, very gradual in this stock.
So therefore, you think that it remains at the current price to book of probably 2 or less?
Yeah, Lata, I think that 6 to 9 months will be the consolidation phase where, old investors will be disappointed. They'll get out. The new ones will become hopeful that, oh, this bank is available at cheapest in, last 12 years. And they'll try to come in. But overall, I don't think we'll see much, much action. Maybe this 1350 to 1500 will be the price band for HDFC Bank, because for such a large stock to reverse the negative move that it has had, I think you will need to see either good growth coming back or good margins coming back. None of it is very easy in my view for the next 6 to 12 months at least.
Okay, so around 1450 or 1400 to 1500 is where it might be, you think?
Yes, that's right.
Okay. Saurabh, what's your sense? That's a fair point, that it is an extremely well-owned stock, especially among foreign funds and, of course, even among domestic mutual funds. And therefore, the rise from current levels is not going to be easy. Would you agree?
I think there's a broader story here, Lata. I think if you see the Indian market over the last 4 years, right, there's been this incredible rally in small caps, driven heavily by retail investors. Indian mega caps, by mega caps, I mean the 20 largest stocks in the country, on price to free cash flow multiples, or price to earning multiples as well. Indian mega caps are the cheapest that they've been in 20 years, right? To get HDFC Bank, to get Indian mega caps, generally the 20 largest companies in the country generally at these multiples, you'll have to go all the way back to 2003. So as we move into the downward phase of the rate cycle across the world, I don't think India will be an exception. I think across the world, we should be seeing rates getting cut over the next 12 months or so. As we move into the downward phase of the rate cycle, and as foreign institutional money returns to India, I think we'll see a more general re-rating of mega caps. I haven't seen this sort of disparity in large and small cap valuations in India for a long, long time. 150% rally in small caps in the last, I think, 2 to 3 years has basically taken away any scope for incremental gains there. So I think there's a general re-rating coming for mega caps in our country. I think HDFC Bank will be a part of that. As Digant says, the sooner the central bank relents on the extreme liquidity situation. Remember, HDFC Bank doesn't have a funding crunch in the sense that NIMs are holding up. Deposit market share incrementally for them is 16-17%, the highest it's ever been. Smaller private sector banks are facing serious pain on the deposit side. I'm sure the central bank is cognizant of the degree of pain the smaller private sector banks are facing on the deposit side. And given that the RBI has been run very watchfully under Shakti Das, I think Shakti Das has taken extreme steps to make sure that the system doesn't suffer crunches, doesn't suffer blow-ups. I reckon the central bank will relent on the liquidity piece. And distinct from that, I think there's a broader re-rating coming from mega caps in the country. One quick disclaimer, I'm invested in HDFC Bank through Marcellus' PMS. So are our 9,000 clients, and so are my parents through Marcellus' PMS.
Oh, yes. Thank you. Thank you very much for that. But I would assume that is everyone's disclosure, every expert we call on the channel. Saurabh, more importantly, do you think there can be larger HR problems? I mean, Shashi Jagdishan will have to actually tell those who are bringing in assets, loans, to please slow down because we don't have enough deposits. Do you think there can be an HR churn?
I think there's two different challenges here, and one of them they seem to be dealing with. One is on their lending rates. On lending rates, they've been extremely aggressive over the last 12 months. I think 2 weeks ago I saw an announcement where they've started pushing their lending rates up, and my reading is incrementally on the lending side they will get less aggressive with their rates, partly to protect NIM, partly given that there is a crunch on deposits, why do you want to be aggressive on lending? So I think we'll see an abatement in the extreme aggression HDFC Bank has shown. I think, when I've traveled around the country over the last 12 months, I've seen on high quality customers, HDFC Banks has been 30, 40 bips cheaper than the other private sector banks. I hadn't seen that before. They've pulled back on the aggression lending. And there's a separate issue on ESOPs. The HDFC ESOP has obviously been very attractive for a whole generation of people who worked there. Given that the stock has been weak over the last 4 years, they'll have to think through the compensation construct around staff for whom ESOPs has been a meaningful part of their compensation.
Okay. Finally, Digant, do you think that, the home loan is inherently a low margin product, would that also be a problem in terms of bringing up their margins?
Yeah, Lata, I think multiple layers of problems, because see, one is when you are offering high deposit rates, you have lower CASA, and it's mostly because you've been forced to digest a very large merger. So not HDFC Bank's fault, but it's just the way things are. I think home loan as a product is definitely going to bite them, and they had these builder loans, corporate loans, which are very high margin for HDFC Limited. Now that will run down under HDFC Bank. So I think there's a lot of pressure, Lata, and let's not forget 2015 to 2020, the PSU banks were not lending, Axis ICICI was not lending, so HDFC Bank had a free run. Things are not like that now, and which is why I think it'll take slightly longer than what we all want it to take. No doubt, it's a great organization, but it's beset with its own set of problems right now.
Just how long will you wait to buy? Level or time? Give me.
I think I'll wait for the time when once first buying can happen when the liquidity cycle eases, as Saurabh was mentioning. The liquidity cycle in the country itself has to ease, and then if there is a micro
just lost
with
it.
an SBI, these are the tracking points where one can build more positions.
Okay, very quickly, Saurabh, when and what level?
I think we're already buying. We've been large investors, and over the last couple of weeks, we've filled our boots up further. You're not going to get companies like this at these valuations for too long. So,
okay, that's most helpful. That's most helpful. Patience is needed on the stock, and it has quite a few problems other than just margins that it has to tackle. Thank you very much, Digant and Saurabh, for joining us. Quick wrap on Bazaar. After a break, it'll be Chartbust.